Hey there, everyone. I'm Scott Welsh, and every Thursday we get together on YouTube to talk about how we can beat the market. And today it is a topic that blew my mind. I don't know if it'll blow your mind. We'll find out, but it kind of shook me up. So let's find out what the heck I'm talking about. Three things today. First, to build a robust system, we must go long and short. That just makes sense. Everybody wants a robust system that will last and last and last. Pretty common sense, long and short, right? Well, number two, should we really go long and short? We shall find out. And number three, let's give some examples of trading in both directions and let's decide for ourselves. All right, getting to know me. This is our segment where I show pictures of me until I speak live to you as any good YouTuber would. I try to give pictures of me. This is me. I was mad about a trade. I got dressed up in my suit to trade, which I normally do. I like to be in full suit here when I trade, but I was angry there, and that's a picture of me. All right, getting to the topic, how to make a robust system. All right, sit down, get out your notepad, right? Is that how people take notes? Notepads? Here's what we should do. Well, one, we need simple rules. Aren't we all in agreement about this? We need simple rules. The more complicated it is, the more chances you have for curve fitting. Doesn't mean you shouldn't try to get complicated. Try it. Can you be complicated simply? Meaning maybe there's a bunch of different things going on, but it's all very simple. Right? If you're a value investor, for example, it might be complicated if you buy and then it goes down and you buy more and it goes down and buy more. Like that can be complicated. Well, at what point do I buy more? Does it have to drop X amount or Y amount? See, that's complicated, but still simple. We're buying something on sale. Anyway, get my drift? Number two, then, once we make our simple rules, we need to apply those rules to both sides of the market. That, again, is common sense. Otherwise, we're curve fitting. If we're only going to go long, isn't that being a little too exclusive? Doesn't that mean that we're going to curve fit our data, meaning fit our data to only a specific type of market? Well, it sure seems that way with our heads. That's why we should go in both directions. Furthermore, look at the market. Look at the charts. Stocks go up, stocks go down. Futures go up, down. Forex up, down. Why would we only trade in one direction? No, I'm not singing. Why? We're just losing money if we don't go long and short. All right? Clearly, we should go long and short, except there's a problem. As we learned yesterday in the Wednesday newsletter, which might change, it might expand. We might do more with that Wednesday newsletter. There's a lot of talk about me doing something different with that Wednesday newsletter, adding on, right? Isn't that, have you heard that on the internet, the scuttlebutt? Anyway, the Wednesday newsletter, we talked about going long and short, and the research in that newsletter yesterday showed us something crazy. It showed us that the long side of the ES, which I'm using as the market, because it basically is the market, the S&P, but it also has leverage. Whoopee! Right. The long side of the market, ES specifically, and I use the RSI off the shelf default indicator. The long side, using that, using RSI as an entry, was nicely profitable. I mean, nicely profitable. Beat the market, nicely profitable. But the short side was hugely unprofitable. I mean, wildly unprofitable. It was not even close to being profitable. Now, what do we do about this? I used the same rules for both. Same rules. Didn't change anything. Well, shouldn't it work on both sides of the market the same way if I have the same rules? Doesn't it make sense? Isn't the long side and the short side just two versions of the same thing? No, at least according to the numbers. It is completely different trading. Long side market trading is vastly different than short side market trading, right? Remember the research or the aphorism or the cliche that the market goes down about 3 times as fast as it goes up? Well, even if that's a little bit true, clearly what we're saying is that these are two different markets. These are two totally different things. So here's the question, and I'd love to hear your answer. Why should we trade both sides if one of the sides is terrible, right? I've read in books that even if it's unprofitable, you should trade long and short because that's how you keep it robust. Really? Really? We should trade both sides of the market when the short side in this example was simply losing us money. We should just do it. Why? Why? I don't get it, right? Now, is the ES, did I cherry pick the ES, whatever? And I don't know. I mean, cherry pick means I'm selling you something, and I'm not, right? How much does it cost to watch our YouTube videos every Thursday? I think it's free, right? So why would I cherry pick if I just want to give you helpful free information? Doesn't make sense. Anyway, is that the only example? Is the ES the only thing that this applies to? Well, let's look at the NASDAQ, the NQ futures contract. This obviously features mostly tech stocks, cool stocks, the stocks that are incoming, right? So maybe using the S&P is different than using tech stocks. And we know how bad tech stocks tank, right? All those short sellers love those tech pump and dumps where it goes up and they short it and make millions, right? Tech stocks definitely drop. So not trading short on tech stocks is stupid because we have to get that short side win, right? Remember 2000, 2002? Honestly, let me tell you one more time. Go study that time period. Unbelievable, right? Unbelievable what happened in that time period. Okay, so tech stocks surely will go down. We should trade long and short. It was just an isolated example on the ES, right? So what do you think? Place your bets. Let me know right now what you think happened on the NQ. I'll wait. Here we go. Here is an entry. If you remember our entry from the weekly Wednesday newsletter and also the YouTube videos recently, I'll give it to you. Again, this is my robot that I programmed to trade this and test this for me, right? We want RSI set to default. Yeah, that's interesting. Tell me more about that Energy Metals trade station. Thank you. RSI set to length 14, right? Right? Set to length 14, default indicator. It goes overbought, right? Then the rule is it has to come down out of overbought, and that's when we buy at the open of the very next bar. So it went up, came down right here on this bar here, and then the very next open, we went short. That's the entry. Default settings, length 14, 30/70, blah, blah. One contract each time, and there is a successful short trade. Wasn't easy, right? Remember, our holding period, if you look back at all the videos, is about 3 months, okay? See, February to May, March, April, anyway. So short, hold it for 3 months, and yay, winner, all right? So let me ask you again, what do you think happened? Well, here's the report. 60-day holding period. Total net profit for 18 years and 8 months was negative $58,000. The short side is not a great way to trade in this manner. Every time we took a trade, we lost 1,600 bucks. That's just awful. Oh, let's peek down to our max drawdown. Oh, only a max drawdown of minus 69,000. Sweet onion pie. Why would we trade short? I thought for sure tech stocks would be great on the short side. And the answer was nope. Here's for fun. Look at the annual returns on this, by the way, right? In 2017, not that long ago, it lost $21,000. I mean, we could have traded this, what, like a $10,000 account ish, right? Whatever your margin requirement is. Wow. Well, how about these 3 losing years? And no, it didn't work. It didn't even work in the 2000 to 2001. Now, 2002 it did, and 2008 calamity it did, a couple of other years, but look at this. By and large, it's horrifyingly bad. All right, enough stock examples, Scott. Stocks are not going to work. Don't use that tone of voice with me. How about Forex? Forex is entirely different. It's not based on something going up. It's not companies increasing in value. It's just the relationship of the economies of various countries, economic policies, Fed announcements. It's all just a bunch of mumbo jumbo, but there is no zero and there is no going up and down as far as value. It's just going up and down based on relationships of different currencies. So clearly, you need to go long and short in Forex. That is not even worth discussing, but I'm discussing it. Okay, I use one of the big top three. The top three volumes on the Forex landscape is dollar yen, euro dollar, you know the big three, and pound dollar, I believe. Now I'm worried that pound dollar is not in the top three, but I know euro dollar and dollar yen are. Anyway, surely in FX, the long and the short are fine to trade. As I just said, there's no upward bias. Now I changed the holding period because Forex is different. So I did just a minor bit of testing to get us a nice holding period. So I got 100 days. Well, we had, if you've watched the other videos, you know that some of those holding periods, even in the stock market or futures market, went up like 80, 90. So not that big a deal. And the RSI, I slowed down to 21. Okay, so standard settings, 30 and 70, but 21 on the length, and I used one lot. All right, time to vote. What do you think happened this time? Well, here's the report. Now, if you can look, sorry I had to break it up. I wanted it all on one slide for you. All trades were 15,000. Okay, good. RSI works very well. Excellent. Uh-oh. Long side, almost 20,000. Short side, minus 41. Are you telling me there's an upward long bias on the dollar yen? Well, I'm not telling you anything. The numbers might be talking to you, though. And over here, here are the drawdowns. This is all trades, long and short. You can see that not only does short lose money, the drawdown is bigger. The long has a drawdown we probably don't like, but it still made money on the long side and clearly did not on the short side. Same rules for both. What does that tell us? Well, it tells us we need to get to the bottom line. It makes sense. Our logical minds. If we're going to make a system, we should not be biased in one direction or the other. We want it to be robust. We want it to have symmetry. It just makes sense. We should use the same rules on both directions. But what do we do when the research dramatically shows us otherwise? Now that's a statement. How about a question mark, right? What do we do? What do we do? Do we keep going? It drives me crazy. The long side and the short side are not the same. So why am I forcing myself to trade both directions when one doesn't make money? Does that make any sense at all? Well, here's the takeaway from my free YouTube video where I'm not selling you anything, of course. Please, please, please check out your system. If you just blindly set up your system to go in both directions, maybe that was a mistake. Will you please check it out? And will you see if there's a big difference? A system can trade in both directions. I'm not saying don't, but make sure that profit is similar for both. And you may have to make adjustments, right? You may not just be able to slap the same rules on the long and short side, okay? There's a chance you might be able to do better if you acknowledge that they're not the same type of market, and I want you to do better. All right. Updates still on Kajabi Next. Newsletter for now is just on Wednesdays, may change. Go to scottwelsh.me and sign up for the newsletter. Do it now. That's my contact information. All right, everybody. That was fun. I hope that helps you. I'll see you again next time. Bye for now.